Good day, everyone. I guess it goes without saying that the outbreak of the COVID-19 pandemic has put cracks on some sectors of the real estate asset class. What we've come to know as normal shopping experiences and daily work-related routines has been disrupted by lockdowns that have led to some shops closing and employees working remotely. With that, words such as working from home have become a much more common part of our daily speak. I guess this work from home experiment has certainly taught us a few lessons. All these years of rushed morning and late afternoon commutes to get to work and home on time certainly does not sound appealing to most workers in a post-pandemic world. We've also come to understand that a lot of the tasks that we used to do in the office can now be achieved remotely and without in-person interactions. So this development has prompted many to speculate on whether these cracks that have been induced by COVID-19 are permanent and signify the demise of the office market, or even lead to questions as to whether offices have lost their purpose to a remote or hybrid working environment. It is important to state at the onset that the concept of remote working has been with us for quite some time. In fact, history tells us that the practice of working from home predates our history of working from the office. But for this discussion, we'll focus on the trends that we've observed in the last decade, where there was already a gradual increase in the share of employees working remotely on a full-time basis, or at least on a part-time basis. A recent study from the Federal Reserve Bank of Dallas in the US shows that approximately 75% of the workers in the US commuted to work every day before the pandemic, while 17% of the workers worked from home some days, and about 7.6% worked from home on a permanent basis. From these stats, we observe that the trend towards remote working observed prior to the pandemic was already an established pattern driven by advancements in technology and was gradually gaining some form of momentum over the last decade. But as the number of COVID-19 cases rose and lockdowns were introduced, the drive towards remote working, which was adopted as a safety precaution for employees, led to a substantial increase in the proportion of workers working remotely. By May of 2020, 45% of the workers in the US worked from home, while the balance of the workers still indicated that they commuted to work every day. So although remote working is not new, the pandemic has certainly accelerated the adoption of this practice by corporates and workers alike. Today, we now have a high proportion of people that had relatively little experience working from home that have now discovered the benefits of remote working. Since COVID-19 is a global pandemic that is affecting real estate markets across the world, research and trends from global markets can provide a picture of how the sector was affected by the pandemic and what the outlook will potentially look like post the reopening phase. But as we've come to learn over the past few months, real estate companies experienced COVID-19 differently. Companies servicing tenants in the office and industrial space experienced better rental collection rates, while real estate companies servicing retail tenants were under pressure. So in the next sections, we'll provide a brief overview of the health of the office sector as seen in other markets, including South Africa, and use observations and surveys on return to office expectations to gain an understanding of what that potentially means for the sector in the near term. Remote working certainly is a headwind to the office investment market as we move closer and closer to the reopening phase. However, the challenges that the office sector is facing at present relates to the low utilization of currently leased space, together with tenant intentions that are susceptible to change at any moment. So looking at occupancy statistics for US office-based REITs as reported by the National Association of Real Estate Investment Trusts, vacancies in the office sector increased by 300 basis points from 6.2% in the fourth quarter of 2019 to 9.7% in the second quarter of 2021. This is for good reasons. As COVID-19 took form, corporates grew concerned about the impact of the shrinking economy on the demand of products and services that they sell to the market. This reality has driven some businesses to rationalize space requirements and pause on finalizing lease commitments. The occupancy trend in the South African office market is no different. The latest data from the South African Property Owners Association points to an office market or real estate fundamentals that are continuing to worsen. Occupancy rates have deteriorated by approximately 7% on average quarter on quarter since March of 2020. This outcome has driven vacancy rates in the office sector higher to around 15% in the second quarter of 2021. So if you look at it, this represents a 370 basis points increase from the vacancy rate of 11% that was reported in the fourth quarter of 2019. Added to that, a number of financial institutions, including banks, who are some of the largest users of corporate space, continue to rationalize their real estate footprint in pursuit of better efficiencies and improved profitability. These moves will continue to add excess inventory into the South African real estate office market. Our expectations, therefore, are for office occupancy rates to weaken further from current levels, driven by a combination of economic factors as well as structural factors arising from remote working practices. An important indicator that we keep our eyes on, particularly in this environment, is sublet vacancy rates. This is because tenants typically place sublet space in the market during recessions and tend to pull that space back when the economy recovers and demand comes back. So this certainly makes sublet vacancy rates an important leading indicator for office demand. So if we look at this from a US perspective, sublease availability surged during the pandemic as many occupiers reduced their office footprint when they shifted to remote working. While this picture differs depending on where you are, the trend across most markets has generally been on the up. In South Africa, albeit data on this is scarce, there has been growing commentary around the increase in subleasing by some of the big corporates. So while sublease vacancy rates are not picked up from headline vacancy rates, the availability of the space in the market contributes to depressed market rentals because the sublet space is often offered at a discount to market-related rents as tenants pursue savings during difficult times. Interestingly though, recent data from markets such as the US suggests that we may have actually seen a peak in subleasing trends with tenants pulling space off the sublease market. According to JLL, the amount of sublease space in Sydney, Australia fell by 8% in the first half of this year. New York is also seeing an improvement following a significant amount of space that was added into the market. So for us, this suggests that the outlook on the economy, on employment, and prospects on return to office are improving from a tenant's perspective. And tenants now realize that they need the space they had released into the market after all. While this seems to be positive, the implementation of return to office policies by corporates will largely depend on the pandemic and the progress made towards vaccinations. We saw companies in developed markets who were encouraged by vaccinations announcing plans to return to offices. Those plans, however, have been disrupted by surging Delta virus cases. Apple, Amazon, Facebook, and Microsoft have all delayed their return to office plans, citing concerns about the surge in cases. So I guess progress towards vaccinations will inform the implementation of return to office plans. Our concern in the short term is that the slower the pace of vaccinations, which will likely be accompanied by recurring waves of COVID-19 infections, will reduce the visibility we need to assess what the future of the office market will look like post the pandemic. That said, we see the office market coming back over the next 12 to 18 months. However, the return to office will be stronger in some markets and weaker in other markets, depending on the rate of vaccinations and the recovery in terms of the economy. Importantly, though, corporates will come back to a labor market that is quite different from one that existed prior to the pandemic, where remote work was a nice to have, to one where remote work is a standard preferred way of working for employees. But some corporates are already adjusting to this environment. The supply of remote work opportunities, as can be seen on this chart, have been on a steady rise since the onset of the pandemic. Between January of 2020 and January of 2021, we've seen an 18% average month-on-month increase in remote working opportunities advertised by companies. This is a clear indication that corporates have seen some benefits to remote working. On the employee side, workers have become accustomed to this way of work. They have experienced the benefits, and there is a realization that it is possible to be productive while working from home. Then comes the question, is remote working here to stay? When looking at this, survey results paint a very interesting picture. Based on return to work surveys done by McKinsey in July this year, 80% of the executives that were surveyed would like to see employees at the office for 3 or more days per week. Employers stress the importance of training new staff, collaboration, and building a strong culture which can only be achieved in person and at offices. On the other hand, a significant share of employees would like to work from home for 2 or more days per week. and more than half of those employees are looking to work from home for more than 3 days per week. So it is apparent that employees value working from home or remotely. Some surveys even show that the value employees place on being allowed to work from home for more than 3 days a week is equivalent to receiving a 15% increase in their salaries. So all of these factors are important considerations in the return to office policies that companies will ultimately adopt. Importantly, while employee demand for remote working is increasing, it needs to be met with equal supply of those opportunities from employers for it to be sustainable and have a meaningful impact on the demand for office space. At the moment, demand for remote work far outstrips the opportunities that are offered by companies. As seen in one of the surveys, more than 60% of the participants mentioned that they prefer work where they can work from home. However, only 9% of the jobs advertised provided the opportunity to work from home. With that, we expect corporates to offer a hybrid model going forward. Within that, there are subsets of choices available for employers. There's an option where remote work is the default option, with offices kept as a base. There's an option where employees divide their time equally between remote and office work. And lastly, there's an option where the office is the primary place of work, where employers provide some flexibility in terms of remote working to their employees. Given that employers have stressed the importance and advantages of being in the office in most of the surveys, we believe that a model which will be common post the pandemic is one where the office is the primary place of work. The shift towards a hybrid model will undoubtedly affect the office market, but the question is to what extent. Unfortunately, estimating how much office space companies are going to need after the pandemic is a difficult task, but we have seen some companies moving to share-offs of space, as well as attempts to measure the impact of remote working on office demand. In one study made by a group of economists at CBRE Economic Advisors in June of 2020, they estimated that demand for working from home will increase by 15% post the pandemic. However, the need for social distancing brought on by COVID-19 will require de-densification of current workplace designs. This, according to CBRE, will result in a 15% increase in space per worker. So on that basis, underlying space demand will then decrease by approximately 2% overall between 2020 and 2025. It is important to stress, however, that real estate markets in various geographies are in different stages of the real estate cycle and will react differently. Demand for space in some markets will come back as the economy rebounds and the demand for workers comes back on stream. This will drive some reversal of the office demand lost as a result of the pandemic. Some real estate markets like South Africa went into the pandemic with excess supply of space. So in the absence of a meaningful pickup in economic growth and employment, this market may experience larger, longer lasting effects resulting from a massive shift towards remote working arrangements. So to conclude, we align our views with those expressed by Nikki Bourjani and Deborah Lavich in the Harvard Business Review, who wrote, "We've collectively learned a lot about how work can get done under challenging circumstances of the pandemic. However, this environment that we're going through now is a process of discovery, and conclusions about the future of work are premature. It will take a while to mine the learnings from how the pandemic impacted our working environment. The right answer for the long term will vary by context, specific working style, and preferences of team leaders and members." Thank you.